The housing market is in terrible shape. In case you haven't realized, affordability has never been worse. People can't afford to buy a home, they can't afford to rent a home. And there are so many people that say the housing market will only continue to go up. And then there are people like me that believe a massive correction is necessary. In this video with Mike Maloney, he has prepared charts to prove to you why the housing market must correct and that we may see a massive correction that no one is expecting. It could be 50% price reductions in the United States as far as home prices, and our current state of the economy may just end up rendering us in a recession that is far worse than the Great Depression. Hope you enjoy the show. Mike, first, I'd like to thank you so much for your hospitality when we were on our trip to Puerto Rico, man. It was just so awesome meeting you, sitting down with you on our Tuesday night podcast. And I really, I can't say how much I value your opinion. And, also, we share a lot of the same sentiments that, the economy, the U.S. economy is in terrible shape right now. We may be looking at another global financial crisis, maybe worse than what we experienced about 15 years ago. But I know who you are. But for the audience that didn't watch our Tuesday night podcast, just tell everybody, who's Mike Maloney?
Okay. Well, first, I want to say right away that I think I agree. The crisis that is coming, I believe, is probably going to be a whole lot worse than 2008. This could be the greatest crisis in history. Now, I'm somebody, when my father died back in the 80s, he left my mother an estate that should have taken care of her for the rest of her life. And we got her a financial planner who then, in the crash of the NASDAQ, proceeded to lose more than half of it. And I ripped everything away from him, and I started studying the markets. And I ended up, I read a paper from Ben Bernanke called Deflation, Making Sure It Doesn't Happen Here. I read that in about 2004, and it just completely changed my life. I gave the business that I was in, which was producing trade shows for high-end audio and home theater equipment, to my business partner. I made an alliance with Robert Kiyosaki, the real estate guru of all gurus, and I wrote Rich Dad's Guide to Investing in Gold and Silver. When this financial planner had lost so much of my father's estate, I started studying the stock markets to wonder, trying to figure out what went wrong. Why did the NASDAQ crash? Why did it go into this bubble? And that led me to studying the economy. And you can't study the U.S. economy in isolation. You have to study the global economy. And there I realized that it was the hard money advocates, the precious metals sector, that really watches international trade flows, currency flows and trade flows internationally. And other types of economists and so on are not as concerned about credit and international trade flows. The hard money advocates are also big advocates. They love monetary history. And when I found monetary history, I just fell in love, and I just started studying this like every day. And then I made this alliance with Robert Kiyosaki. I saw him, I believe, in 2003, and I started going to his conferences and stuff. He'd have events in Scottsdale, Arizona, small events where he'd be a 3-day event where you go and do a book study or something like that. And by 2005, I had gotten to know him just enough to where I could ask him, can I be the Rich Dad advisor for precious metals? Because the very first event that I showed up at, I was the only one that brought charts. So I caught him coming back from lunch and I said, I've got these charts. Here's the Dow gold ratio, and here's 9 different currencies measured in gold from 1900 until today. And I offered to get them reproduced for everybody. And he just says, no, we'll handle it. And then he put me on stage later during that conference. And then he did it in the next conference, and the next conference, and then in front of 5,000 at the Los Angeles Convention Center. And then I did the Learning Annex Real Estate Wealth Expos that he was doing. And so the next time I spoke with him was in front of 30,000 people at the LA Convention Center, and then 15,000 in Atlanta, 15,000 in New York, 10,000 in Chicago, 10,000 in Boston. What I'm seeing today, though, is so similar. I started showing data of the scale of the real estate bubble that was happening. And this was Dr. Robert Schiller of Yale University. This was his data before he did the S&P, the Schiller S&P index. This was when he was still just at Yale. And so I was showing this data back in 2004 and 5 and warning people that real estate was going into the biggest bubble in history, and that this would have negative consequences. And so anyway, when I saw what was coming after reading that paper from Ben Bernanke, Deflation, Making Sure It Doesn't Happen Here, which he wrote in 2002, I don't think I read it until 2004. That's when I just decided to completely change my life, because that paper was a roadmap to the future that we're in right now. And so, I mean, I really did change my life. I changed businesses. I wrapped my entire life around economics, monetary history, precious metals. And recently I wrote another book, my second book, called The Great Gold and Silver Rush of the 21st Century. And what I wanted to do there was to try and condense all of the information that somebody needs as to where the global economy is right now, and the potential outcomes, comparing this to especially the precious metals bull market of the 1970s, so that you can see what the outcome will probably be this time around. And so that's called The Great Gold and Silver Rush of the 21st Century. And people can go and get, there's chapters 3 and 4 are free online at GGSR21. So the easiest chapter 3, and the most fun probably, and then the hardest chapter 4, are both online. And I needed them there so that I can make improvements after the print book was published. So that's my background, and I also opened up a precious metals dealership in 2005 called goldsilver.com, and we've grown to be one of the largest online precious metals dealers in the world. And I introduced being able to purchase like you're purchasing a book on Amazon, where you can just put a down payment on a credit card, wire transfer, or you can buy the whole thing on a credit card if you want, but there's credit card fees. But you can lock in a price right now, purchase online, take delivery at your home, put it in an IRA. And I was also the first to create storage accounts at Brinks for our customers. It's actually your storage account. We do the billing on behalf of Brinks, but it's in your name. And we have vaults in Singapore, Hong Kong, Canada, the US, and Europe, and I think Dubai, or I can't remember. So
gold's hit new highs. I mean, so yeah, that's definitely, and Mike, you are probably one of the highest regarded teachers on money. I mean, I love everything that you do. For everybody listening, you can check out the show notes. All of Mike's links are below. I have his books. I highly recommend it. And I can tell you, I mean, he has this whole chronicle of money, the teaching people about, the value of money, understanding the monetary value, the difference between money and fiat currency. It's just amazing stuff. But, Mike and I, one of the nice things sitting down to dinner together when I was in Puerto Rico is, and we've talked about this even afterwards, a lot of people don't really understand what's happening in the economy and how markets react and to the debt and things like that, and to the monetary policy. And we want to dive in here, Mike, because you taught me a lot. I've been in the housing market since 1989, serving the housing market. I was a contractor, a builder, worked for home builders. And you even said to me that a lot of the real estate people that you talk with don't understand. Everybody wants to cheerlead and say, well, it's a supply and demand issue. And, we're not going to see a correction in our market, maybe somewhere in the U.S., but not here. And but let's just dive in, Mike, because the value in the charts that you've put together, I just want everybody to understand. And guys, when we're looking at or hearing information, I think this is the important thing. A lot of people just want to listen to mainstream media, and there's a lot of agenda-based messaging going on when you're listening to the media talk, right? Because let's face it, they don't want to tell you exactly what's happening because we might respond differently and stop spending money and doing whatever that would be important to save ourselves and to really not continue to kick the can down the road. But when we look at the data doesn't lie. And I believe if we want to be smarter tomorrow, we have to take a step back and just look at some historical data, because even though history doesn't always repeat itself, there are cycles in this, guys. There are cycles in the economy. And when we understand how these bubbles are created and what happens when they are, what do downturns look like, we have to look at the chart. So Mike, just kind of take it away and let's tell everybody what's in the chart.
Okay. First, I do want to say when you were referring to the difference between currency and money and the resources that on my YouTube channel, I've got something called Hidden Secrets of Money. And I think that's one of the things that you were referring to a little while ago.
Absolutely. Love it.
It follows the history of money, but more importantly, how it affects you today. There's many different documentaries and such on the history of money, but most people do not show how something that happened in Athens in 407 BC is similar to what is happening right now. So anyway, the economy is basically like a three-legged stool. There are three main pillars that hold up the economy. There's obviously the stock markets. People think about the economy and they think about the grocery store and the gas station and so on. And then there's the debt markets, which are big. And then the real estate market. These are the three main pillars: real estate, debt, which is the bond market, and the stock market. And so I want to take you through these three legs of the economy and show you where they are now, because in 2008, that was basically a real estate crisis, but it also dragged the stock markets down with it. And so in the year 2000, there was a stock market bubble and we had a stock market crash. It didn't touch real estate. It didn't touch bonds. In 2008, we had a real estate bubble, but the stock markets were also in a semi-bubble. It wasn't, and it had come down close to fair value, but it bounced back into a bubble. And real estate dragged the stock markets down with it, but it didn't touch bonds. Bonds were not yet overvalued. Today, everything is overvalued. It's the almost everything bubble, with the exception, I believe, of precious metals. And it could be cryptos. It's hard to measure cryptos. We don't have a lot of historic data. They started in 2009, basically. But here we have the Robert Shiller's Real Home Price Index. Real prices are inflation-adjusted prices. And what he's done is he went all the way back to 1880. And then he has inflation-adjusted home prices from the year 1880 until today. And this data is about 1 month old. And what you see, then he adjusts this all to a factor of 100 at the very beginning. And you see homes, the actual value of the home, that from 1920 to 1940, real estate was very undervalued. And then pretty much fair value until the 90s, when it just took off into this hyper bubble, reaching almost 200% in the year in about 2005, and then 2005, 2006. And then it crashed with the crisis of '08 and so on. But then it's gone back up into a bubble, And when I wrote my book, you see that it was at about 210%, except it's at about 225 now. So this is the greatest real estate bubble in history. Now, I've been presenting this chart since right there. The first time I presented this, I believe, was Silver Summit in 2004 or 5. I think maybe it was 5. But I've been presenting this to investors and warning that there was a massive bubble coming. And I used to go to these events in 2006, 7, and 8 and with Robert Kiyosaki. And when I would show this chart and I would show other charts, the gold real estate ratio and so on, and individual investors would say, oh, yes, but it won't affect the real estate I'm in because it won't affect this sector of real estate because. And they all got affected. And anybody that was over leveraged, that couldn't withstand a little bit of downside risk, that couldn't withstand having to lower rents or a higher vacancy rate or something like that, they got wiped out. And so have you got anything to say about this chart? And then I'll show you another way that we can measure real estate.
Yeah, well, I'd like to ask, when you were presenting it in 2004, I mean, when we got to 2007, 2008, and I know, Robert Kiyosaki, he really sort of led the way on, investing in real estate, and it was easier to invest in 2008 than certainly 2004 because it was going up. And in our market here in Maryland, we sort of peaked in 2006, so right in line with what you're saying, Mike. But when you were speaking about this, warning about the bubble in 2004, I mean, in 2008, maybe they were believing you a little bit, but 2004, I mean, do you think people are in denial right now like they were in 2004?
Yes, I've been, back in 2006, when the Learning Annex Real Estate Wealth Expos were happening, Robert would come out on stage and he'd open his show with, real estate's going to crash and all you flippers in the audience are going to get slaughtered.
Wow.
He was talking to a real estate crowd. So he,
Wow.
teaches cash flow investing, and he doesn't like speculation. And so he was just being absolutely honest and telling the truth. And everybody in the audience was just shocked when he would do that. But yes, I am seeing the exact same thing today, where there is a justification of why it's not going to affect them. And so, one of the things, there's, do you know the real estate guys? Do you know Russ Gray?
Absolutely, yeah.
Yeah. So Russ Gray's been through this before. I'll be interviewing him on my channel sometime soon. But he said that, he should have, that it is prudent to take some equity out and invest in an inversely correlated asset that will go up when real estate goes down. When the bank takes a look at your balance sheet, when you need to refi or whatever, or when interest rates change, you don't have to worry about it as much. And so anyway, should we move on to the next chart?
Mike, if I can, just one more question here. When I'm looking at the crisis of '08, and it still appears that despite the bubble that we had leading up to that, when we saw the real estate crash, it looked like the bottom was still overvalued more than it has ever been historically. So we didn't even then see, the complete adjustment to what would get even close to the 100 line, still higher just about than right. Any other time. Do you believe that where we are right now, being at, now 140% over that real home price index, do you think that we're going to see some type of real estate correction or crash that will go beyond even closer to the 100 line than we saw in 2008?
Yes. And the reason goes back to, toward the opening, I said that in 2000, there was a stock market crash. In 2008, it was stocks, it was real estate and stocks. And this time it's going to be real estate, stocks, and bonds. It's the three legs that are just incredibly overvalued. And so this probably will be a horrific crash that will readjust everything. what we've got here, this is everything that is happening. The reason that this 2008 bottom did not come back down to 100, it didn't come back down to fair value, and it did the same thing for the stock markets, basically. We never visited undervalued territory. So the dead wood never got cleared out. The free markets weren't allowed to clear because they are not free markets. They are a manipulated market, manipulated by the Federal Reserve. When it's the Federal Reserve creating artificially low interest rates, they're creating artificial demand. And then supply tries to meet that demand. Too many homes get built, and as soon as things start to correct, the Fed has to intervene again and keep the bubbles going. So that's how we ended up with the biggest bubble in history. But it's this time it's going to be 3 bubbles bursting at once, not just 1 or 2. And so I believe that the devastation will be far larger than 2008.
Wow.
So let's move on to the next chart. This is just another way of showing that we are in the biggest real estate bubble in history right now. This is the home price to median household income ratio. And what you see here is that people used to pay about 4 times their annual income for a home. So if you're making $100,000 a year, you can afford a $400,000 home. But then we get to the real estate bubble of 2005, 6, and 7, and you can see that people were paying about 6.5 to 6.75 years of income for a house. Well, we're up at 7.33 years now. We're in a much larger bubble than we were in 2007 by this metric and by the last metric. It's the biggest bubble in history, and so the correction will most likely be more painful. And since we've got both stocks and bonds that have been in hyper bubbles as well at the same time that we're in this hyper real estate bubble, they're all going to drag each other down. I believe we're headed for a just horrific financial crisis.
Up in Boston, Massachusetts, there was an article that was published by the Boston Globe that spoke about their market being 8 times. So yeah, I mean, there's certain markets that, I mean, it's even higher than this. I guess this is sort of like a national average maybe. But I think this is the pain that everybody's feeling and that we deal with every single day and trying to help buyers. I mean, they were kicked to the curb. In the early on in the pandemic, they were kicked to the curb because they didn't have cash to compete with institutional investors. They didn't have, the people that were, selling in California with domestic migration, selling their houses at the highest, values ever seen. And so they were able to move domestically to areas that were, cheaper to buy a house, but they inflated those markets, and buyers just couldn't compete. And then what happened was we watched the largest rate hike ever by, any chairman of the Fed and Federal Reserve. And so we saw the largest, fastest rate hikes that has ever happened in history in the period of, a year, really. And that kicked them to the curb once again. And now, Mike, I think the sad part here is that now people are in so much debt that even if they could have purchased last year, if interest rates hadn't have gone over the top for mortgage rates, the buy market hadn't increased so much. I think these buyers would have been able to buy, but now they've gotten themselves in so much debt because of inflation and credit card debt that yet this now third, I'll call it the third leg of the stool, is hitting them. That even if the rates come down, a lot of these buyers are just in too much debt right now. They're getting their teeth kicked in by the banks that are charging these credit card companies the highest rates of interest that we've ever really seen. So this is, this really important information.
I have to compliment you on you're a real estate guy, but you also look at the fundamental economics of the entire economy, and you're trying to navigate this more than just somebody that just goes forward on the same thing over and over and over again, not looking at all of the things that can just come out of nowhere and affect you. And one of the things that we have seen is that, like 2008, that came out of nowhere. And I think that we're going to have, it's interesting how so there will be some small things that happen, and then they get closer and closer together, these things that are happening, and everybody thinks that it's been fixed up and patched. And then one day they're on the news, they're saying Lehman Brothers failed. It's, and yeah, global financial crisis, bank holiday, stuff like that.
You're right.
So anyway, yeah. So I've been showing people this this type of information since about there on the road with Robert Kiyosaki, and you are one of the people that is really paying attention to the entire economy. But the other legs of this three-legged stool, the three pillars of the economy. This is a chart from my book, and this is the PE ratios of the S&P 500. And so the PE ratios is the price of a stock divided by the earnings per share of stock. And so it's one way of, if you're paying, a multiple of, they used to say that fair value was about 12. You pay 12 years of earnings per share for each share of stock. That's the price of the stock. That was fair value. And here what you see is a median of about 13 and a half, 14 from 1880 all the way until the early 90s. And then it starts climbing, and it went to a hyper bubble. And you can see the bubble in 1929 was at about 32 or 33 multiple. And we went up to about 43, I think it was, in the year 2000, and then the stock market crash. And we came back down to fair value in 2008. But, before 2008, when real estate crashed and all the real estate derivatives brought down the world economy, the stock markets had gone back up into a bubble of around 27 or 28 on the PEs. So they were in a bubble. And so when real estate crashed, it drug the stock market down with it, but it didn't touch bonds. Well, we're in a bubble now, and this was when the book was written. So this is it's the end of, it's mid 21 when this chart goes up to, and the stock markets have rebounded significantly since then. So we're back up at like 30 or 30. We're back up to probably where we were in 1929 before the great stock market crash. And then there's other ways of, so that the black arrow is where the global financial crisis, where the implosion of real estate started to affect the stock markets. And when I was touring with Robert Kiyosaki and giving these things, this is another way of looking at it. The Buffett indicator is you take all of the publicly listed companies. So it's the number of shares out there times the price per share gives you the value of the stock, the dollar value of the stock market. And then you divide that by the global, the GDP, the value of 1 year of all the goods and services produced in the United States of America. And this value of the stock markets have no business being over 100% the size of the economy. This is just the publicly listed companies. It doesn't include all of the dry cleaners and local grocery stores and restaurants and things that are not big publicly listed companies. But you can see here that in 2021, it was over 200% of the economy. There's never been a bubble on this scale before. And, you can see where 2008 was, where real estate drug down the stock markets. It was a bubble that was much bigger than we had ever seen prior to. We're in what I call the bubble century. Everybody has gotten used to these hyper elevated prices. This is one of the most revealing charts, I think, and this one goes back to 1860. And this is the average wage in the United States, the number of hours that you would have to work with the average wage to equal the points on the S&P 500. So basically, if you could buy one share of the S&P 500. And you can see that there was an equilibrium of about 22 hours of work required to buy the S&P 500. It never exceeded 40 hours, and it never really went under 10 hours from 1860 all the way until the 90s. And then toward the late 90s, it just jumped up into this hyper bubble, and it's never come down to fair value ever since the late 90s. It's never visited this fair value territory where it's oscillating above and below fair value. And we've gone from an average of 22, and when this chart was created, we were at 122. And so it's just been totally insane. It's nothing sustainable. And when the reversion happens, it's going to be one of the biggest reversions in history. And there we have when real estate started to drag down the stock markets. So you got any comments on these charts? Because I think that these are actually more revealing than things like the price earnings ratio and so on.
Mike, is there any correlation with this? I know in the 1980s is when we really started offshoring our manufacturing and became more of a global economy. And, I look at this chart and I think, well, geez, this is no surprise how the middle class is being destroyed. But when you look at this from the mid 80s and we see that spike, is the correlation between this S&P chart and the fact that we pushed manufacturing offshore, is that related to this?
I'm going to have to study that further. That's a hard comment to make right off the top of my head. I've never been asked that before. But when you go offshore, you are increasing corporate profits by taking advantage of much lower labor costs. And so I don't have I should have a chart of the company profitability. I know that there are more zombie companies out there today than ever before. That a zombie company is a company that can't afford to pay just the interest on its debt, let alone the principal, out of current cash flow. So they're having to do things like borrow against accounts receivable and equipment and buildings to be able to pay the principal on the loans that they've got, but they can't afford to keep up with the interest out of current cash flow. So that suggests that the offshoring, it may have had a temporary increase in corporate profits, but it wasn't something that is sustained throughout this century. So my guess is that my answer would be no, that this is an anomaly of this century that I think is going to be corrected, but it's going to be corrected through a lot of pain. There's going to be a lot of, right now there's been this huge wealth transfer. The Federal Reserve creates currency and out of nowhere, and they do so by buying something. When they buy something, the currency is created. And what the Federal Reserve Act restricts them to buying is to buy things that are backed by the United States of America as to principal and interest payments. And that means U.S. Treasuries and now mortgage-backed securities. And they have to buy those on the open market, the Federal Reserve Act specifies. Well, they've created their own open market of primary dealers, they're called. So these are 18 to 32 of the largest brokerage houses in the world that compete. They have to show up at Treasury auctions, and then they have to buy and sell treasuries and mortgage-backed securities to and from the Federal Reserve. And so they have to be market makers of these debt markets. And when they create currency, it has to go through brokerage houses. So it pumps up the financial sector. And you see there is an amazing correlation with the amount of currency that the Federal Reserve creates. And, if they create 20% more currency, the stock markets go up 20%. Well, where did that purchasing power come from if they just type a unit of currency into existence? And you notice I say currency, not money, because this isn't money. Money has to be a store of value. Aristotle was the first person to define the key attributes of money. It's got to be a medium of exchange, a unit of account, and it's got to be a store of value. Those are the three key attributes that something has to have to be called money. The US dollar has gone from being worth 1/20th of an ounce of gold to 1/2000th. You know, it used to be $20 for an ounce of gold. Now it's $2,000 for an ounce of gold. And so it has fallen by 99% since the Federal Reserve took over. And what you see today is currency appears out of nowhere. It's typed into existence. The Federal Reserve buys something. It goes into the markets. But when the Federal Reserve sells something and they take that currency and the currency vanishes. So how can it be a store of value if it's just appearing from nowhere and vanishing? What's happening when it appears from nowhere, it's diluting the currency supply and stealing purchasing power from all the other units of currency in existence and transferring it to these new units that they've just purchased. If it goes into the stock markets, into the financial markets, because they're buying bonds basically, but then the brokerage house may replace those bonds with stocks or other things. And so it lifts the entire financial sector. And since it's stealing purchasing power from diluting the currency supply, it means it's robbing the average person, the middle class, and transferring that wealth to people that get their net worth from their stock portfolio. So if you've got a lot of stocks, if that's your key source of wealth, the Federal Reserve you might be twice as wealthy as you would have been had the Federal Reserve not gone and stolen purchasing power from the average guy and transferred it to you. And they just don't seem to realize how immoral what they are doing is, and that, you know, they need this needs to stop. But we live in this world with this absolutely evil monetary system that not only is based on fraud and theft, but it enslaves all of us, because when the Federal Reserve buys a U.S. Treasury bond, we have to work in the future to pay the principal and the interest on that Treasury bond that the Federal Reserve bought by typing. You know, the difference between $1 and $1 trillion is just typing 12 more zeros.
My calculator doesn't go up that high. Well, you know, Mike, I mean, this chart is amazing. And, you know, I just think, you know, I know back, you know, doing some studying back in the 80s, looking at this chart back in the 80s, I know that in the early 80s, only like 1 in 4 manufacturing jobs were offshored. And then over the next 20 some years, we, you know, took 40% of our manufacturing offshore. And I just know that, you know, we had a decent wage increase, so something that really supported inflation really up until the 1980s. And then from the early 1980s until where we are in 2020, I think we only really realized about 17% wage growth, and home prices went up over 300%, I think 300 and close to 10%, you know, the increase in home prices. So, and a lot of markets more than that. But I mean, this chart's fascinating. You know, when you look at, you know, how many hours that you need to work to, you know, buy a piece of the S&P, crazy, man. It really is. You know, people just don't realize we should probably be spending a little bit more emphasis teaching our kids, you know, what you're teaching, or at least turning on the YouTube channel for them and letting them watch so that they can hear it from somebody. Amazing. Yeah.
Yeah, it's time to stop watching mainstream media. That is for sure.
Yeah.
The trigger for all of this, I believe, is, you know, they raised interest rates at the fastest pace impossible. What you see here, this is the 30-year Treasury bond price index. So it's the inverse of yields, basically. And this was an absolutely picture-perfect bull market from the 1980s until today. I don't think there's ever been a bull run that has lasted that long.
And Mike, and that's what I'm kind of curious about. I mean, it's so fascinating you showing this data, because if I think about it, and just, you know, average guy, I've been in business since 1989, and I've weathered a lot of storms. But when I'm looking at data like this, and I'm going, man, if we're in a situation where we become a world economy, now the government is more focused on us importing and being the largest buyer of GDP than any other country. So the pressure is on for them to continue to satisfy this, Wall Street demand essentially, and to, pad the pockets really of, countries like China, for instance, where we get a lot of our products from. I mean, China sells us more stuff than they sell themselves, and they have a lot of people, but they don't pay the prices for their goods that we do. And I just look at this and I'm like, wow, at what point, do we realize that this can't go higher? I mean, we see that now coming down. How is this bond market? How will it crash? What will be the tipping point for that when we're talking about, the stock market and its vulnerabilities? And then we talk about the housing market and its vulnerabilities, but then we're talking about treasury bonds. We're talking about U.S. treasury bonds. It's backing. I mean, you would think, man, if that collapses, we are in big trouble. So what is this tipping point?
Well, you were talking about China, and they can't type the global reserve currency into existence, and we can. And that has supported these trade imbalances to where we can buy so much stuff out of China. But, China's goal after Mao died became employing their population, keeping the population happy by giving them some work and an income. And so, China, I've been there, and it is the Communist Party controls the commanding heights. So the power generation and some of the biggest things in the economy. But when it comes to small business, it is the Wild West of capitalism there. And that what has elevated these millions of people out of poverty. But anyway, the trigger, the catalyst is these the change in interest rates. And you and I were talking about commercial real estate, and commercial real estate is in some serious trouble right now, along with residential real estate. But commercial real estate, I don't know the scale of the bubble. It's harder to get information on commercial real estate. I know that a building recently that was in New York City that sold just a couple of years ago for $65 million just went for 16. And that is a pretty large price decline. The problem is, as you know, commercial real estate is when you go to refinance, the bank is going to value that piece of property not by the structure and the location as much as the rental income that is coming from that property. And so after COVID, we've had these very high vacancy rates. Occupancy might only be 50% on a building, where normally it would be at like 92% or 96%. And here we are at 50%. So the bank takes a look, and then people with it at 50%, any new offices that get rented or whatever, retail shops, get rented at lower rates because there's competition to get these spaces filled. And so the dollar amount of rent is going down, and then you've got all these vacancies. And so when you go for you were just telling me that 30 years don't exist and 15 years. So what is the term on your typical commercial real estate loan? And, what kind of trouble do people get into when the building appraises at half what it did before, and they've got to roll over a loan at these higher interest rates with much higher payments?
Well, and that's really double where, a lot of people are. So a lot of the real estate, the commercial loans are at about 3.75% to 4%. And now we're sitting at, a solid 8%. So anybody coming up for refinance, they're literally looking at the interest portion of their debt is doubling. But that's not really the problem. So you have two scenarios that play out with commercial real estate, and the terms, Mike, typically are 5 and 10 year terms. And over the last 5 years, no one wanted to give a 10-year term. Well, very few wanted to give a 10-year term because they knew they were at historically low rates and they were banking on this rate increase, this hike. But really, there are two types of situations here with the commercial. One is a recourse borrower, and the other would be a non-recourse borrower. So meaning the recourse borrower is where the bank gave them the money, whether it's an owner-occupied building or not, meaning that the borrower maybe has their business located in that commercial real estate versus it just being for speculation, for tenant speculation. So that recourse borrower is really the one that's in the most trouble right now because, individually, when a borrower buys a commercial property, not only is the bank, going after them, signing a personal guarantee, but they're cross-collateralizing all of their assets that they have. And that means their businesses, sometimes their spouses get included in the note, as far as guarantors, and it can even extend to their home. So these are the ones that are really in the biggest trouble, that are up for refinance, that are struggling to do so. The non-recourse simply turn their keys back in. And for a lot of these borrowers, they're only out, their risk is just their deposit, which may be, 20%, 25, 30% of what they originally purchased. They're kind of capped out at that down payment that they, when they originally purchased the property. Sometimes investors are even the ones that help to raise that money. So, that's diluted on the larger scale to a lot of these borrowers. They just turn the keys back in. But let's just talk about the recourse borrowers, because that's a lot of America, right? So these are the people that, tried to do a little bit better for themselves, maybe wanted to own the building that their business is in, and maybe they have multi-tenants, they only occupy one space, or maybe they're occupying the whole building and their business is just down over the last several of years. So now they have to refinance that property. They have to requalify all over again. So if the bank is analyzing that property from a cash flow basis and it's not cash flowing, or there's rent delinquencies or vacancies, they might not even have an appetite for a refinance at all. And a lot of the different classes of real estate, the banks throughout time, they get overweighted in certain classes. So a lot of these that own the office space, office buildings, even if you have the ability to repay it, they're not comfortable with the office space at all. And they'll require that that building owner, to come up with a huge amount of cash to refinance. And it could be millions of dollars in cash out of pocket, which the owners may not have. And the rates are going up, and the whole rules just are going to change. And I think that what has happened here in the last several decades, Mike, is we have glamorized real estate investing. And we've glamorized it to the point to think that over the last 10 or 15 years, there really hasn't been any risk, because interest rates have been low and the economy has been chugging along. But I think everybody knows, especially the banking sector, they know that it's not as rosy as, mainstream media is putting out. And they're the ones that are looking at their assets going, look, now's our chance, guys. We need to restructure this. We're in trouble. And Mike, I know you're prepared to show some information on the banking, sector, but that's really, It's a mess. What we have going on right now is a disaster in the commercial real estate space, especially if you're an office building holder. And now I'll just segue into this just briefly. On whitehouse.gov recently, they just published a fact sheet where the Biden administration, what they want to do is they're putting in play this, rehabilitation. Here we go, October 27th. But what they want to do is they want to convert. They know the banks are in trouble with office space. So what they put was this plan out to convert commercial office buildings into residential. And they want to kind of incentivize this whole plan. The problem is when the government, I don't care who the administration is, but when the government shows up and says, hey, I'm here to help, we can just pretty much, go, oh, geez, here we go, right? And it never really works out well. Here's the problem, Mike. It is common knowledge. I mean, you can Google search this, you can check it out. We are going to be in a glut of multifamily housing. What the government's plan to come up with converting these office buildings into multifamily housing is probably the worst idea that I've heard yet in the near term, considering the fact that we have over 1 million in production right now that's going to hit the market in the next 12 months of multifamily housing all over the place. Cranes have been occupying the skylines, building apartment buildings. And they're now getting, these apartment operators are now realizing they need capital calls. They can't even continue their construction in some cases. And now they're going to be looking at some of the highest vacancy rates we've seen in multifamily housing in decades. So, I think, that's just the tip of the iceberg. But one more thing before I let you go back into the charts, this is even crazier. A lot of people think that the housing market, and we're showing it's not as solvent as you like to believe, because FHA now has a new plan they just put out for comment in May. They have this plan because they know that all the bailouts haven't worked. They know that, all of the mortgage forbearance hasn't really worked. We're now looking at FHA delinquencies, and FHA is the new subprime lender, in my opinion. They're the Lehman Brothers, essentially, the government's the Lehman Brothers back in the leading up to the '08 crisis with subprime. And basically what's happening now is we've got almost 10% delinquencies in FHA, despite all the bailouts, despite the mortgage moratoriums. And now the FHA just came out with this new program they want to launch where they take, I think, up to $1,000 off of people's mortgage payments, as if the 40-year mortgage wasn't enough, taking 30% of the mortgage debt, putting it on a second mortgage in the back, interest free, wasn't enough. Now they want to drop their mortgage payment by up to $1,000 a month for FHA borrowers struggling, and they want to do this for a minimum of 3 years and a maximum of 5 years. Right here it is, FHA mortgage reduction plan. So, this is brand new stuff that this administration's hoping to get out by the end of the year, Mike, that they will be able to hopefully continue their administration in the 2024 election.
Yep. It's, you're blowing a balloon up and it develops a hole and you slap a Band-Aid on it, but you keep on blowing. They're just making this bubble bigger and bigger and bigger. And they keep on slapping Band-Aids on, any problem that develops. But the Band-Aid that they're creating just puts more air in the balloon. And it's going to end up being disastrous. So anyway, this was where we were back in 2008 when real estate crashed. So bonds were not in a hyper bubble. They were becoming overvalued, but this is the trigger that started it all. And I made videos on this as soon as they started raising rates. This is the year over year percent change in the rate increases. And it's like Powell didn't seem to understand that raising the rates a quarter point or a half point from when you start from 8%, like we did back in the 70s or 80s, up to, you go up half a point. If you're at 10%, you go up half a point, you're talking about a 5% year over year change. And here, when you're talking about 0.1% and you go up this is a 4,500% year over year rate increase is where this chart peaks. And that rate of change is what has upset the apple cart. And I'm surprised that things have lasted as long as they have, that the economy has held together for the past year and a half. But I think, by the time we get the rate cycle started in March, so we're coming up on 2 years, I believe, of this rate hiking. And it's all going to come to an end soon, I believe.
Mike, you know what the craziest part about this chart is? This is almost how silly it is, right? This is the Federal Reserve's chart. I mean,
yes, I make these on the Federal Reserve's website.
Right.
Yeah.
I mean, when you look at this chart, I mean, this is the Federal Reserve's chart. They created this chart. So when you look at it, you say, what were they thinking?
Yeah, if you go to the St. Louis FRED, FRED, this is their research and education division. So you go to there, they've got more than 500,000 data sets. And so you can generate all sorts of charts. So I generated this chart on their website. And it is, which I do all the time. I can spend an entire day sitting on their website, generating charts, looking for anomalies. And so I've been showing this chart since about June or July shortly after they started this rate hike cycle. I was warning that this is going to end up in disaster. And I still believe it will. There's no way to go back and fix this. And there's the rate hikes, but they're also trying to reduce the balance sheet. So basically, they're lowering they're extinguishing dollars that they had created. And as they extinguish them, we go into a sort of so we've got inflation. I call it indeflation, inflation and deflation going on all at once. And so just to give people a taste of, to jog their memory of how the 2008 financial crisis, so the last time we went through a really big crisis other than COVID, a real financial crisis, in April of 2007, New Century Financial went bankrupt, and people sort of went, wow, that came out of nowhere. That was unusual. But it got papered over, it got fixed, and things went on. And it took 5 more months before there was some other sort of red flag in the economy, bank runs in England. And then 6 months later, Bear Stearns collapsed. So each one of these was sort of fixed, papered over, government took care of something. And so 6 months later, but then 4 months later, IndyMac and Countrywide financial collapse. And this really starts the ball rolling. 2 months later, Fannie Mae and Freddie Mac are nationalized. 1 week later, Lehman Brothers. 1 day later. So now we're getting into most people will remember when you woke up and all over the news was Lehman Brothers. And then the next day, AIG. Now, AIG isn't a bank or a brokerage house. That's an insurance company. But it had to get bailed out because of the insurance it was making on derivatives and such. 9 days after that, the largest bank failure in U.S. history, Washington Mutual. And then a month later, Fed's TARP program, and 1 month after that, Citigroup, and 1 month after that, General Motors and Chrysler get bailed out. And 1 month after that, Bank of America gets bailed out. And so these things, I believe that what we saw in March of 2023, March and April, where we had Silicon Valley, Signature, Silvergate, First Republic, and then a few weeks later, there was Credit Suisse, which if that had actually failed, that was a shotgun wedding that the government had arranged between Credit Suisse and UBS, so that the bank wouldn't fail. If it had failed, that would have been much bigger. That was a truly systemic thing. So if they hadn't arranged that merger, we would have seen the entire world financial system freeze up. And when you're running a whole monetary system based on nothing but credit, and that's all the dollars are that exist today, they're all credit. It's most of the currency supply is bank credit. Less than 10% is created by the Federal Reserve, and that's Federal Reserve credit. So J.P. Morgan famously said that gold is money, everything else is credit. And it is true even to today. So this is sort of the way that this played out. If you look at the center of all of these circles, that center corresponds to this time scale. So you can see that there were problems in the banking sector, and then we had IndyMac and Countrywide right here. And then later was Washington Mutual. And it sort of cascaded into all of these banks and then eventually petered out. Well, look at the very first, the center of the circles, again, are the time scale. So you had these things happen first, and then IndyMac and Countrywide, and then this big circle. Look at what has happened already. And if you would put Credit Suisse on this, it would be a circle bigger than the height of this whole entire chart. So we've already seen this giant crack, this tear happen in the global financial system. It's big. And I believe that the rate hikes and where, it's interesting. You've got a bundle of dynamite and you've got all these fuses and you light all the fuses at once. And it doesn't matter which one gets to the one stick of dynamite first. When it goes off, all the rest of them go off at once, even though their fuses have not burned down to the stick yet. And I think that's what we're saying here, because we've got, commercial real estate, we've got residential real estate, we've got the stock markets, and we've got bonds, and then the entire banking sector is on very unstable ground. The next chart here,
Mike. Before we go on that, I'd just like to ask you a question. If you could just go back to that chart, in your opinion, I mean, when we look at what happened leading up to 2008, Ben Bernanke had said, that the housing market was fine, that the banking industry was fine, and just weeks before. And interestingly enough, I mean, here we are, prior to March of this year, March 12th weekend, when we learned about Silicon Valley Bank. Didn't Powell just testify to Congress that the banking industry was okay? I mean, what am I missing here? I mean, how is it that our central banks, our central bankers, our chairmans of the Federal Reserve, what am I missing here? I mean, at what point are they just not looking at the data? I mean, if I run a business, right, which I do, and you're a smart guy, I mean, you're probably, one of the smartest guys I've ever met. And because you take the time before you say something, you take the time to research it and back up what it is that you're saying, that you truly know what you're talking about. Running a business, I have to look at financial statements. I have to look at comparisons. I'm looking at, my financial statements month to month in comparison to last year and the year before. I'm looking at expenditures. I'm looking at percentages of costs and profits and losses. And, I mean, this is just me running a small real estate brokerage here in the state of Maryland. We're talking about central bankers that are running our whole monetary system here. Why is it that they can be so wrong just weeks before we learn about massive collapse?
Well, there's only two possibilities here. One, they're lying to us. And if they are, it's immoral and they belong in jail. Two, they're incompetent. And that means that they do not belong in their job. So take your choice. Do they belong in jail or do they belong out of their job? Those are the only two possibilities. They're either incompetent or they're lying. Sometimes I think they're incompetent, but most of the time I think they're lying. So whatever they say, I sort of take it and flip it upside down, except their lie works for a little while. But then when it all unravels and the lie is exposed, you see the truth. So to figure out what's really happening, I sort of take whatever they're saying and think the inverse. But then again, you don't know how long that's going to take to become obvious to everybody. So, okay, so I'm going to move on with this, but here's the state of the danger that the whole financial system is in. Now, what I want to point out to you here is that this starts in 2008, and the banks were not in really bad shape in 2008. This is unrealized losses on lenders' balance sheets. And so these are, this is debt that's held to maturity and debt that's available for sale. So they've got U.S. treasuries and they've got mortgages. And if they say that it's going to be held to maturity, they don't need to disclose that. They can put face value on their balance sheet. And if it's available for sale, they have to they have to mark the debt to market. And so the blue is all marked to market, whether if they're in profit or losses. And so this blue would be on their balance sheet, but all of this red would be concealed. And then somebody has gone through and looked at the assets that the banks hold on their, and then marked them to market. And these would be the true losses. Now, the worst, this one I found just a few weeks ago, but these are the four big banks that they're unrealized net losses. And, I have accounts at I've got, several corporations, as I'm sure you do. And I've got accounts at Bank of America and several other banks. And I think I might want to reduce my exposure at Bank of America.
Wow.
Doesn't look too good, but it's the one that's in the biggest trouble right now. And then, the whole point of all of this is, have we passed the point of no return? Is there any way to fix this? And this is something, everything that you looked at, all of those other charts are from chapter 5 of my book, where I'm talking about where the world economy is. And, it's called the Great Gold and Silver Rush of the 21st Century, but there's only about 20% of it. 80% is not about gold and silver. 80% of it is, if you learn how the economy works, a little bit of monetary history, how currency is created, I believe that you have a much better chance of coming through things like what we're going to be going through with a much better outcome. Just know the fundamentals of everything, so that when stuff is happening and you can look around, everybody else is confused, but you'll be going, oh, this is happening because this plus this equals this. So this, one of my researchers and my spreadsheet guru and chart master, Alan Hibbard, took the debt, how much deeper we go in debt each year. And to do that, you can't look at the surplus and deficit, because those are sort of lies. You have to look at change in national debt. If they say, oh, we had a surplus last year, like they did back in the year 2000, but the debt actually grows that year, it means you didn't have a surplus, you had a deficit. You're in debt, deeper in debt than you were the year before. And so that means you spent more than your income. It's that simple. And so I ignore what the government says when regarding surpluses and deficits. And I just look at change in national debt to figure out whether we spent more than our income. But when we used to borrow, back after World War II, we would borrow $1 and get $1 deeper in debt as a country. We would borrow $1, but it would produce somewhere between $6 and $8 worth of GDP growth. So you could literally borrow your way to prosperity. This is what you do with cash flow real estate, is you borrow your way to prosperity. But what you see here is, as the debt climbed higher and higher, the return on each dollar that we would borrow became lower and lower. And then, ever since the 2008 global financial crisis, every dollar that we borrow now only produces 30 to 50% of growth in income. And so that means that we can no longer borrow our way to prosperity. It's impossible. It can't happen. But the politicians have not awakened to this, and they still think that we're in this old mode that we were in before 2008, and they're trying to spend our way to prosperity. And this is a recipe for disaster, on top of all those other things that you just saw, the three pillars of the economy, stocks, bonds, and real estate, all being in hyper bubbles that are currently deflating. And what happens, you reach a top and it starts to roll over, and then a crash begins. It doesn't just go like this. It usually climbs and then starts a rollover, which we've seen. And I believe that there's going to be a panic and a rush out of a lot of assets. And I think that we're in for the greatest financial crisis in history.
Mike, when?
I think 2024 starts it. I think we're going to be fine for the next couple of months, hopefully. I don't know what time in 2024. If not 2020, it is an election year. So they are going to try everything they can to try and keep these bubbles going. But you have to, when you've got this many leaks in the balloon, you got to really increase the volume of air you're trying to pump into it. And so, the Fed would have to do a pretty dramatic reversal. But see, that scares everybody. And so it makes bond investors more cautious. It makes, even if you take rates down to zero again, you can't force a bank to make a loan on a property that they see as risky. You were talking about commercial real estate and that the rates have gone up so much. But then if the bank looks at that piece of property that they had financed at whatever amount back in 2019, and now they want to, the rates have gone up to where the rate is quadruple what it was in 2019, the bank still may not be willing to give you a loan at that quadruple rate. They might either require you coughing up a huge amount of cash or a rate that instead of 4 times 2019 is 5 or 6 times or 7. There is some risk reward balance where a bank might want to refinance your property, but
it's counterintuitive, right? I mean, they could say, hey, I could refinance the $1 million and make double the amount on interest, but what they're really saying is, I'm not even comfortable with that. I mean, we don't even want that extra revenue. I mean, we want to take the exposure down. So now we want you to put $300,000 down to refinance, and we'll take the $700,000 note at the double interest rate than what it was 5 years ago, versus the opposite. Well, let's go back to that chart, because this is what I'm talking about, Mike, and why I love talking to you, because if anybody can look at this and see, this is the destruction of capitalism. This is capitalism. Yeah. On the left side of the chart is capitalism at its finest, and borrowing money to make money, right? When you look at that, you say, hey, I can remember those days. Hey, you get a loan for business, and the purpose is you take that, you invest it in your business, and you make, here you are, $7.50 on every dollar you borrow. That's the way debt was, really in a capitalistic country, what we were founded on, right? Capitalism, freedom, and being able to, free markets survive, right? And adjust and do things on their own. I mean, we look at, they corrected themselves before the government started getting involved and, manipulating and, doing what they do. And here over the course of all of these decades, we're talking about years. Every day, debt didn't work that much more for its intended purpose. And in fact, they never paid off the debt. They only incurred more debt. So the cost on the debt that they had really chopped at the only opportunity that they had for profitability. And eventually that collides after the 2008 crisis, after we have one of the largest market bubbles ever in history, the real estate market. And now it's continuing to decline. And, a lot of people say, by 2030 or whatever, 2033, that the debt, just the government's debt alone, will exceed the amount of revenue that they collect from taxes, the income on taxes. So you know what that means? That means we're going to be paying some more taxes.
Well, I think that this chart is a chart. It's an end game chart that, the party's over. This is the chart that says that the next crisis is probably going to be the greatest financial crisis in history. Because, back in 2008, that was 2 bubbles collapsing. In 2000, it was just the stock market. Now you've got stocks, bonds, and real estate, and they're collapsing in an era. When the other ones collapsed, we were above that red line here. Now we're significantly below it. There's never been a crisis to happen where the government can't just pony up and do a bunch of deficit spending to get us out of it. It won't work. The other times we were above zero here. And so I do not have a whole lot of hope for, by the way, that's where we were in 2008. And so we were when real estate crashed, this was still positive. It's Bernanke's policies that took us below that zero line, and we're still implementing the same policies.
Mike, what can people do? I mean, I know, you believe, you teach that everyone should have gold. Can you kind of just, end us on that? I mean, what should people be doing right now? And should they be buying gold, and, should they be buying the physical, or, just investing in the markets?
Well, I never give advice. What I tell people is what I do. And most of my net worth is in precious metals. Russ Gray says he says you can pull equity out and then of real estate or something else, and then buy a reverse correlated asset. And when you look at what happened to precious metals during the '08 crisis, when real estate kept on falling, real estate fell by about half, and precious metals more than doubled during that period of time. That means that by the time the real estate crisis is over, you can buy 4 times as much real estate with the gold that you bought. And silver is, I believe, that's where the majority of my precious metals holdings is in silver. I use the gold-silver ratio. So you divide the price of gold by the price of silver, and you get that ratio. And right now, an ounce of gold is like 80 times the cost of an ounce of silver. It was up at 120 times. And so when it's over, when it's like 50, I will buy a 50-50 mix. And when it's over 80, I buy only silver. And so it keeps me from buying one metal. During the COVID panic, gold and silver crashed, and I wanted to buy gold so badly, except the ratio was at 120. And so I bought silver because but people's natural tendency is to go toward gold. And the gold-silver ratio keeps me from doing that. But I also bought farmland. I've got a very large farm at the very top of Puerto Rico, and I invested in being off the grid. So I've got 100 solar panels and 9 Tesla Powerwalls. I've got redundant internet with a microwave internet and Starlink. And I have my own water source. There are 10,000 homes that get their water from an easement on my property. And so that's my main river. And so I've also I've diversified into, I'm pretty much prepared for like anything from, a mild correction to a zombie apocalypse.
I'm coming to your house. If that happens, man, get ready. I'm moving in.
Robert Kiyosaki used to teach about the 5 Gs that you want: ground, so real estate, defensible real estate. You want grub, food. We grow our own food. In fact, I'm growing broccoli and asparagus in Puerto Rico because it's at such high altitude up there. It's somewhere between 8 to 14 degrees cooler than it is down here in San Juan. So ground, grub, gas, and I've been driving Teslas now since my 2010 Roadster. I am actually on my 9th Tesla. I currently own 6 Roadsters and a Model 3 dual motor performance. And you want, so gas, ground, grub, gas, guns, and gold. Those were the 5 Gs that Robert used to teach to be ready for anything. And so I took it to heart. I've literally got that. And then I've got a mountain peak where from the front gate to my mountain peak is about 2 miles. And there's many spots where I've got a clear shot.
You're prepared.
Right. So anyway,
well,
so
I appreciate you, man.
Those are the three pillars of the economy. And if you've got two legs that are weak and crumbling, and one leg that is, when we create currency, when there's a crisis, they're going to be creating currency. And so the debt markets will grow, but it's going to be growing. So you've got two legs that are weak and crumbling, and one leg that'll be getting longer, but it's going to be made from very weak. It'll be made from balsa wood with cracks in it. And so this stool eventually has to, and then you take the weight of things like war and the dollar slowly losing its reserve currency status, and just all of the different things, the political division that we've got. I've never seen anything like the hatred between the left and the right at this point. And it's I wish there was an economics party. You've got the Democrats and the Republicans, and I basically think about everything in economics because it really is the difference between prosperity and starvation. And I'm trying to figure out how to create maximum prosperity for all of mankind. That is my goal. And you do that by trying to get as many people understanding economics as possible.
Absolutely. Well, what a wealth of knowledge. Speaking of, finances. So, Mike Maloney, I thank you so much. I know our audience has enjoyed this podcast. And like I said, all your information is in the show notes. And I look forward to connecting with you and having you as a contributor on our channel, Mike.
Okay,
So
thank you.
Yeah,
thanks, Todd. It was great.
We appreciate it. And we'll be talking to you soon.
Okay. We'll see you then.
Okay. Thanks so much. Guys, I hope you enjoyed the show. If you did, you can let Mike and I know by smashing that thumbs up button. And now's the time I want to hear from you. What do you say now? Were you a bull in the market that maybe thinks a little differently about the housing market? Or do you still believe home prices are only on the upward trajectory? Or do you believe that we're looking at something that could be pretty bad in the next year or so? Love to hear your thoughts and comments. Drop them below. If you haven't subscribed to our channel, consider doing so now. You can hit the alert bell. You'll know every time we upload content. And guys, one of the things you can do for me, the biggest favor that you can do besides watching our channel, because I love our audience, is share us with your family and friends. If they're interested in anything real estate, this is your channel. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.